Hi, I'm Tom Lydon, editor of ETF Trends here in New York at the iShares Connect conference. And I'm here with Dennis Clark, Managing Director of Shelton Capital Management. Dennis, thanks for being here.
Thank you, Tom.
Listen, you guys have basic asset allocation strategy. So people watch you and go, yeah, so what's the big deal? Asset allocation, I can almost do it myself, aside from the importance of regular discipline. But on top of that, you do something else that makes it quite unique.
That's right. In fact, it's an approach that you couldn't even talk about 5 years ago. Now, we're writing covered calls on those ETF positions.
Okay.
Covered calls have been around forever. They're the most conservative use of options one can use. But the ETF market, as it has grown, now has options with a very deep and wide option string, so it's very liquid. For example, in GLD, some of the deepest option strings available on the market.
So how does that work? If you've got an asset allocation strategy, what does the covered call strategy on top of that, what does that do for the end investor?
Well, the strategy was developed primarily for the defined benefit market because it's by mandate, that is the IRS and the Department of Labor, it's supposed to deliver a very smooth set of returns with a lot less volatility. So it really grew from that. If you have an asset allocation model and you're enjoying the benefits of modern portfolio theory with lots of diversification, because again, the ETF industry has those covered, by writing the covered calls, it will deliver the same performance or outperformance with about a third less volatility. So for those clients that are still scarred from the 2007, 2008 experience, what they're getting is a total return very consistent with a very well-diversified portfolio, but in a smoother ride. That's what the income from the premiums of the covered calls do for the end user.
Okay, so calls produce the premiums. During those times of volatility, if things happen to fall off, those premiums help absorb the decline in the marketplace, correct?
That's exactly right. We see a lot of advisors and their clients who are looking for something more than just a static asset allocation model. They're asking, well, what are you doing for me? Where's an active part? Some people respond by using a tactical approach. That's not what we're doing. What we do, the active part, if you will, is the covered call writing.
That's great. So there are a lot of people out there, a lot of advisors who have asset allocation strategies. That's great, but as we've had kind of a 5-year bull market here, people are concerned about volatility in equities. They're concerned about rising interest rates, what that's going to do to the income market. And then with a covered call strategy, a little bit of a safety net, what you're providing.
That's exactly right, Tom. And, again, for those people that remember the experience of a market meltdown, or those that have, for example, advisors used covered calls in the past, this is a way for them to deliver to their clients an active strategy while enjoying the benefits of a strategic asset allocation model.
Great, perfect. Thanks, Dennis.
You bet. Thank you, Tom.